It is Abdulkadir, PhD economist in central banker who work for the Central Bank of Turkey in research and monetary policy department and market research approximately 9 years. Until today, we try to cover lots of investment decision, macroeconomic and financial perspective together. And today, I will try to give an idea on the portfolio allocation and long-term investment decision. Because people lots of times maybe make a mistake or misuse the understanding of the long-term investment decision and the short-term perspectives. First of all, before starting my presentation, if I save the word there, I will read it for the all participant, what we mean by long-term investment perspective or what we mean by trading in the financial market. Because lots of people, maybe you know or not, because of the escalating crisis in Middle East today, the gold prices and oil prices rising up, right? It is because they are safe haven and because the markets does not allow the risky asset, and because of those political risk in Middle East crisis, lots of investors taking position in gold and the oil market, and oil is because of the. So maybe today you can take a position and buy a gold, owns gold, and tomorrow you can sell with a profit. But I wanna make a differentiation between the long-term asset allocation, long-term investment decision, and short-term trading. And let me read that word to all participants, and you may understand from there easily this. In investing, always remember that Rome was not built in a day. Rome is the capital city, is the Roman Empire, right? And Roman Empire approximately lived 2000 years. And they managed approximately 1/3 of the world, right? 1/3 of the world population. But those capital cities, the Rome, while making investment decision, you should keep in mind that Rome was not built in a day. It was built approximately in 1000 years. And while making trading, always remember that Hiroshima and Nagasaki destroyed in a day. Okay, so while saving your money, while keep up your long-term investment decision, you should keep in mind that Rome is not built in a day. And while making a trading, sell and buy activities, you should keep in mind that the Nagasaki and Hiroshima just destroyed in 1 second with an atomic bomb in the Second World War. So if you are making a trading decision in an unknown asset that you don't know, and if you take a position there, then you can even lose 50% of your overall wealth in 1 hour or even 1 minute. So please keep in mind that you should be critically careful while making those type of investment decision. During the presentation and slides, I will try to make a better explanation how the investment banking, how the financial market decision makers allocate their portfolios in different assets, and what is the benefit of the long-term investment decision rather than the short-term trade. In chat side, understand some points, or if you wonder or wanna get an, you can directly and simultaneously write your question in the chat side. End of the session, I will try to cover all these. I will try to cover all these slides. Just 15 minutes, I will try to give to participants a microphone to make a question and answering session, like short 15 minutes question and answer side. So Here our first slide. Please take a look at it. You should understand the slides and charts as well. This is a portfolio diversification perspective from an investment banking side. And this is on the y-axis. Look at here. Annualized return, mean at the end of the year, what will be my asset? And in the x-axis, in this side, we have annualized volatility. Okay, meaning that volatility is the up and down side of the assets. Okay, this is volatility. If maybe some participant here familiar with the statistical issue, and when we speak about the volatility, we generally speak about the variance. Okay, variance or standard deviation. Those are, just think this, our first movement around the mean is mean. Our second movement around the mean is the variance. Our third moment around the mean is skewness, and our fourth moment is kurtosis. So if you want to take a look at the shape of a curve, and if you want to make the understanding what we mean by kurtosis, variance, standard deviation, those are generally about the generating moments around the mean. So if I deviate from the second derivation of the mean around, so I will get a variance. So if something has a huge variance, this means that higher variance refers to a higher volatility in the market. So if an asset is risky, their variance and their volatility is generally higher, because you can get higher return only in higher risky asset. If something is less risky, their return also generally less than the average market. So look at this side. As you see here, we can take a 40-60% equities and the bonds, and their general volatility and the annualized return is around 7.5. But if I can increase my equity, look at it, 80% of equity and 20% of bonds. Now my volatility is 13%, but my return only 1.5 points higher from 7.5. It is just 9. Look at it here. I'm here. My return from here, my return is here around 7.5. If my return increase 1.5 to 9, my volatility is increased from 7 to 13% if I change my asset allocation from 40 equities to 60 bond and 80 equities to 20 bonds. So as a participant, what should you understand from here? What is the basic message here? If you understand this portfolio asset allocation, you can easily understand how the market decision maker and how the market indicators related with the volatility and the return perspective. So here, as you see, what is my higher weight in bonds, right? What we mean by bonds? Bonds are generally treasury bills and government bonds. They have, we generally call them as fixed income securities. What we mean by fixed income securities? If I take, let's say, United Kingdom or United States or France or Germany government bills or treasury bonds, this means that at the end of the maturity, the government of Germany or treasury of the Germany or treasury of France or United States will pay the agreed amount that we make, let's say 3 years ago. At the end of the maturity, they will pay this money for sure. For sure, okay? Without any risk, you will get that money at the end of the period. This is a fixed income security, bond. But equity, let's speak about an equity like Amazon, like Tesla, Microsoft, or you can think lots of S&P 500 different equities or securities. I mean, by the way, equity or the stock mean the same understanding in the financial market. So if I speak about the stock exchange, this means that this is an equity. Okay, this is a company like Tesla, like Amazon, like Microsoft, like Murphy Oil, like Alibaba. Okay, these are equities that is quoting in the stock exchange in may I request something? Please don't move your mouse on the screen because Solomon doing something on my slide and putting dots in every slide. Can we stop this? Solomon, you are still on the screen. Okay, I think it's stopped. So I can here directly say that if you are speaking about bonds or bills, okay, treasury bonds, treasury bills, or government bonds, these are fixed income securities. And at the end of the period, you will get the money that you agreed initially. For instance, 3 days ago, Goldman Sachs equity prices, just let me share my screen. And we should keep in mind that bonds are less risky asset, fixed income securities, and paying the money at the end of the maturity. But the equities like IBM, as you said, like Microsoft, like lots of technology giants, Google, Amazon, Alibaba, all those things, and even lots of companies all around the world, like BlackRock, like JP Morgan, like Goldman Sachs. These are, and if you take the position in these equities, you can be hugely rich if you are not in the correct position in that stock exchange. So as you see, if I increase my equity position from 40% to 80%, double it. And if I decrease my bond position from 60% to 20%, now my return is just only increase 1.5 point, but my volatility, my risk, you can think the volatility as risk indicator, it increased from 7% to 13%. So from this picture, you will easily keep in mind that to decrease the volatility and the risk, you can increase the position in the bonds and the fixed income securities, but they will give the lower return to you. But if you like the higher risk and higher return like this, as you see, higher return and higher risk, here 50% equities, 20% of loans and the bonds, and 30% of alternative investments. So in any case, let's continue our presentation. And this is institutional investor behavior for the asset allocation. Okay, what we mean by institutional investors. Dr. Lambert, Dr. Frankis, or Abdul here, Lamina Kamara, or me, we are the private investors. We are personal investors. We are not institutional investors. Institutional investor is like the Nomura, like BlackRock, like, as you say, HSBC or UBS. They have asset management team. They have huge money to invest lots of different positions. And where these institutional investors taking position in the asset allocation side, they are saying that it is around 30%, 35% in equities generally. And approximately, if it is endowment, and today the corporate banking is approximately 50%. Hedge funds is generally, first of all, hedging means that if I am taking a position in a market, in a stock, in anything, in any asset, I can make an hedging position by taking reverse position. For instance, let's say I'm a petrochemical company. Okay, I'm producing petrochemical products all around the world. And today, I'm expecting that 1 year later, the petroleum price will rise up approximately 30%. So if this sensitivity in my mind is strong, then I can directly take an hedging position in derivative market by taking today how much I need petroleum in international market for the 3 years after, not today. I'm saying that for any derivative market, please sell me, let's say 1 million barrel of oil for the 2026, 3 years later, with this price. Because I wanna hedge my position and decrease my risk by fixing the prices. Okay, so this is hedging. And hedge funds generally making hedging operation all around the world in stock exchange, in FX market, in derivative market, lots of places. The private equity, you know, these are the private equities. Real estate market, you know, the mortgage market as well. So the asset allocation is generally here, equities and fixed income. And the less weight on hedge fund, real estate, and other alternatives. And people generally put their cash around 3%. So 3% cash hold as a precautionary motives to take additional position in upside and downside risk. And when we look at the next slide, this is about the return and valuation by style. What we mean by this, as you see here, I can make my allocation by growth portfolio or value portfolio or blended portfolio, mixing of them. So if I find a unicorn or startup that give an expectation for the market, they will increase their profit in 2 years 5 times. If I add this unicorn to my portfolio, this will be a growth portfolio because it will increase and growing every year. But value portfolio like IBM, they have lots of experience, like Mercedes. Well, they paved the way. They paying dividend for their investor and shareholders, and they get, and what we mean by this value, they prove themselves to the market. Okay, no need to prove additional things. They prove their brand, their priority, their market and brand managing all around the world. So they are value. They are producing value. But unicorn generally, new companies or companies making new investment, they are generally growth companies. And as you see, when we look at this next slide here, this is generally directly comparing the returns and valuation by the sector. What we mean by valuation? Valuation meaning that if we taking the multipliers of the sector, we can produce an expectation for the next couple of years market price. This is valuation. And the return, how much I will get return with these multipliers and valuation. So as you see here, we have S&P and Russell. These are stock exchange all around the world. And these are the sector in the column. Okay, look at the column: energy, materials, financial, industrial, consumer discretionary, technology, communication services, real estate, healthcare, consumer staples, utilities, and this is the whole weight of the S&P 500 index. So if I take a look at the column here, then I can easily see that S&P is, for instance, energy for 4.7%, or for the consumer staple it is 6.6%. Then I can here see what is the return of the period. This Q to date, QTD, meaning that quarter to date, what happened in the last quarter, okay, during 3 months. And YTD is the return year to date, from the beginning of the year until today, year to date return. Okay, I am taking year to date return. So if I take a look at here, for instance, in energy market, quarter to date is greater than the year to date. What we mean by this? So the energy companies, energy prices hugely increase in last quarter, and their stocks in the market increase, but their stock prices at the beginning of the year is really low. So overall performance is just 6%, meaning that until last quarter, their prices from the year beginning approximately decreased 6%, then increased 12%, and overall effect is approximately 6% now. So when we trying to look at the growth and economic cycle, what we mean by here? Energy market is generally cyclical with the growth and the market perception. For instance, look at the consumer staples and consumer discretionary. For instance, if you are taking a position in consumer staples and consumer discretionary, generally these are the goods and services like water and the bread. Okay, so if you are taking a bet from the market, their elasticity of the demand elasticity is really low. If I'm buying a water, even somebody say me €5, and if I'm thirsty on the street and there is no another place to take a water, I can pay whatever the amount. But for the energy, it is not like that. Okay, so the consumer staples is, for instance, technology, or let's say communication services. If I am living on the mountain, I don't need a new iPhone. Okay, I can live without an iPhone on the mountains, but I cannot live anywhere without water. Okay, consumer staples is like that, and the technology is like that. So the technology prices is a little bit more volatile than the consumer staples, because this is more dependent, people dependent, and their profit margin is low, and their price volatility is lower. And here you can see also in this row 20 years average for the PE ratio and 20 years average of overall return as well. So in this means you can easily understand that, by the way, what we mean by forward PE ratio. Forward PE ratio means that we can easily understand from the price earning ratio how much the asset is expensive or cheaper. So if I have on an indicator PE is higher, meaning that price to earning ratio is higher, this asset generally is expensive. So for instance, let's say, what are the best well-known investors all around the world, like let's say Tim Rock or those type of people. What they are doing filters on their assets, and they are saying that if the PE ratio less than 20, if the growth ratio is higher than 5%, so they are filtering the asset and they are taking the quality asset. So if PE ratio, price earning ratio, is higher for an asset, it's the amount that it can pave the way. So it is really expensive. So I don't want to take a position in such a risky asset. And here we are, fixed income market dynamics. What we mean by the fixed income a few minutes ago, fixed income is government bonds or treasury bills all around the market. And this is 2-year, 5-year. By the way, when you see TIPC, these are treasury inflation protected securities. What we mean by this, these are, because today if I get a 2% at the end of the year, but if the market, I'm losing money for 4%, right? Because my nominal return is 2%, but prices increase 6%. So net real return here is approximately -4. But if I don't want to suffer from any increase in the prices in inflation, in treasury inflation protected securities, creating your loss because of the inflation. Okay, and here 10-year, 2-year and 5-year return, as you see, for any type of asset allocation. And here you can see any risk interest rate with the 2-year treasury yield, 5-year treasury yield, 10-year treasury yield, US aggregate, convertible, municipals, mortgage-backed securities, and asset-backed securities. What the 1% rise or fall in interest rate mean? First, you should keep in mind that bond prices and the interest rate is in the reverse correlation. So if the interest rate, market interest rate rise, the prices of bond will decrease. Okay, always keep in mind. So if the interest rate increasing, my position will be lost the money in government bonds and treasury bills as well. So market, if I want to get a profit in fixed income securities, the interest rate should be at the highest level, and the 5-year yields we have, and why the market interest rate decrease the prices of the treasury yield. For that reason, any risk in increase in interest rate will decrease our overall return on the investment side. For that reason, if you wanna take a position in a fixed income security, your expectation should be the market interest rate will be decreased in coming soon. Otherwise, if the interest rate in the market increase, your position will lose the money at the end of the period. And here we have the global fixed income all around the world as well. And from here you can see directly what is the global bond market overall valuation. And as you see here, today, emerging market, developed market excluding United States, and United States global bond market is around $140 trillion. This is a huge money. This is greater than China, United States, Germany, France, United Kingdom, and all these countries' gross domestic product. This is a huge money, all participants and dear participants. This is a huge money all around the world, and $140 trillion means there is a huge and deep market in global bond and financial institution. And here we have what we have here. We have here the asset class return for large capital market, fixed income securities, emerging market equities, small cap, or cash. So from this matrix, I will share all slides, and from this matrix, you can easily see from 2008 to 2022 what happened to global asset allocation. And look at here, from here to here, I am going to an asset allocation line like this. Move the mouse and follow my mouse here. This is an asset allocation line, and this is showing how I am taking the position all around the world with financial market. And here, what I have, what I want to emphasize here, these three charts. Please take a look at these three charts, and please try to understand the overall perfect effect of long-term investment decision. What we mean by here long-term investment decision? This graph saying you that if $100,000 was invested in S&P All Ordinaries in 1979, approximately 40 years ago, it would be $1.4 million in December 2022. What does this mean? In 42 years, my $100,000 will increase $1.5 million. But what is the more dramatic story here? if I take during the 40 years all dividends and put those dividends to same index, now my $100,000 will be $8.5 million. So please look at here. Please look at here. Approximately during 20, 40, 30 years, my money is still around just 2 million. But in just approximately during 30 years, money is not growing. But during just in 10 years, my money is quadrupled, meaning that 4 times higher. So if I do the same investment decision in S&P ISX 200 resources index, if I put this $100,000 in the S&P 200 resources index, now my money is just around $1 million, meaning 10 times higher. But if I put it here, during 40 years, my money is 40 times higher, something like every year it is doubling. Because I just put 100,000 and now my money is $4.6 million. And the best story is coming. If I put my $100,000 in the industrial index during these 40 years, my money is $2 million, meaning 20 times higher. But if I put this money in the industrial index, then collect the dividends and reinvested these dividends into the index, now my money is $15 million, meaning 150 times higher to my initial investment. Okay, this is the long-term investment story, ladies and gentlemen. If you take long-term investment decision until your retirement, you will get, even you can pay every expense during 1 year just with the dividends that you get from your investment decision. So this is my last slide. The last slide is showing that return on an asset for the industrial and resources, and look at this graph. In 2022, if I put an equity, okay, meaning that I'm putting an investment, and at the end of the year, 16% I'm getting in the resources index because of my initial investment. But this is just around 2% in 2022 if it is in the industrial index.